Hello, good afternoon. This is Nate Zeller with Security Retirement. I'm the Chief Investment Strategist. Thanks for joining us on our market huddle today. I do want to apologize that we had some email issues, so the invite and all the info got out a little bit late. So my apologies for that, especially for the people that have to catch the replay later because of that. What I did want to do is talk about just what's going on in the markets today. And there's not necessarily today, but over the past week or 10 days, basically since Thanksgiving. Give everyone an overview of kind of how we view things, what we're looking at in the short term, and really going into year end. Hopefully, this is somewhat interactive. I'm certainly open to thoughts and ideas from any of you. So if there's something you disagree with, don't hold back, don't hesitate. Certainly open to some discussion here. So we'll get into it. I should mention that today is Monday, December 6th, 2021. We have to give our usual disclaimers that these opinions are subject to change without notice, and that's very true with today's presentation, given all that's going on in the market. Any type of investing involves risk, and there are no guarantees. If you do have questions about basically don't necessarily use this as individual advice for your own portfolio. If you do want to discuss your own portfolio, please give us a call. We'd be glad to do that with you. So let's jump into it a little bit more. Let's take a look and talk about what's been going on in the stock market the last couple of weeks here. So this is the S&P 500 going back, and hopefully, I don't know if you can see my mouse. Hopefully you can here. Running up till Thanksgiving, it was really looking pretty good. And then the day after Thanksgiving, it seems like the wheels fell off the market. And it dropped quite a bit. Now, the day after Thanksgiving traditionally is volatile. There's not a lot of volume, a lot of people on vacation. Really, the robots take over, so to speak. There's a lot of program trading going on. The high frequency traders were, when something starts to go one direction, it continues that way with the momentum. So, but what drove all this was the announcement of the new variant of the COVID virus, or at least that's what's being blamed for it. So that Friday after Thanksgiving was a pretty ugly day. The Dow ended up being down almost 100 points. We saw a lot of the reopening stocks, casinos, airlines, cruise lines, for example, had a pretty bad day, while the vaccine manufacturers, some of the testing, some of the healthcare companies did quite well. That was low volume. So we thought that coming back the next Monday after Thanksgiving, everybody gets back after eating lots of turkey and they're ready to go again. That we would see a bit of a rebound, which we did on that Monday. However, it really didn't carry over to Tuesday, which was another down day. And then Wednesday was really an interesting day. The market started up higher. Things were looking better. The news on the virus was better than expected. And Fed Chairman Jerome Powell gave his testimony to Congress, right? He can even nail it down to the minute practically, where he came out and said, hey, we're getting rid of the word transitory. We're looking at our tapering of the asset purchasing that's been going on, the monthly bond buying, and I think we're going to speed it up, as his comments, which was a bit of a surprise. Everybody thought with the virus that maybe it would go the other direction, that he decided to slow down the taper, but he said, no, inflation is real, it's persistent, it's sticking with us. So what we're going to do is possibly speed that up, or at least talk about it at the next Fed meeting, which occurs next week. And we'll talk about the Fed in a little more detail here in a second. So that really sent the market quite a bit lower very quickly. Last Wednesday, Thursday, it jumped up a little bit, and then Friday was another down day. That's being blamed on the jobs report. The monthly employment report came out less than expected. It still showed job growth. Unemployment rate dropped to 4.2%, which is very low, the lowest it's been since pre-pandemic. But it wasn't, the market had hoped for something better to help push it up. I will mention, though, that this reminds me a lot of our September jobs report, where something similar happened. The numbers were worse than expected, but it still showed pretty solid growth. Then over the next couple of months, the numbers were revised higher, so it looked better, looking through the rearview mirror. So it doesn't seem that the jobs report was a complete disaster by any means, but it did enough damage on Friday to push the market lower. And it's hard to see here. Right at the end of the day, there was a lot of buyers came in. Last 10 minutes of the market, it was really trading near lows down here, and then it did bounce back because I think a lot of people said, hey, there's no reason for it to be trading this low. Let's hop into it. And lo and behold, that's where we are today. And the market's really made a very strong rebound. Last I looked, the Dow was up, 600 or 700 points. S&P was up about 1.5%. But it's been interesting. We've also seen a rotation during this time with what's going on, a rotation out of some of the high flying tech stocks, we'll call them, the things with very high multiples, the very expensive tech stocks. And we've seen a bit of a flight of quality into other more quality names in the industrial space, for example. Utilities did quite well last week. That was maybe a flight to safety, if anything. And some of the tech stocks have held in quite well too. You look at an Apple, for example, that was actually a little higher last week, and some of these bigger names with reasonable valuations have hung in there quite well. But it's those more risky names that have really suffered. Anyhow, that's just real roughly kind of where we're at right now. Another thing I'll mention too is this time of year tends to be pretty volatile. There's a lot that goes on at year end. A lot of the mutual funds, even your larger pension funds, do year end positioning. With the mutual fund, it's interesting. They report their holdings quarterly. So at the end of the year, they want to make it look like they've been holding these stocks that have really done well. So they can go to their clients and talk about how great everything is. And so a lot of times we'll see them sell names and buy into other ones. They also do it. Mutual funds will do it for tax reasons. They pay out their capital gains at year end, and so they'll, having to pay those out, they'll have to do some selling. Individuals as well do a lot of tax loss work at the end of the year. They'll sell the tax loss harvest. Some people, and this year is a little bit different, going with what's going on in Congress. With the potential the bills, the infrastructure bill and we'll call it a social spending bill, the prospect of higher taxes next year, there's a number of people that are probably selling to reset their cost basis just to lock in gains this year, which normally doesn't happen. But that seems to be what's possibly driving the market this year as well. So let's touch on COVID and Omicron. I know everybody probably has COVID fatigue by this point. I know I certainly do. Part of this has been interesting, and I don't mean to make light of the situation, but I've learned a lot about the Greek alphabet. Omicron's the 15th letter of the Greek alphabet. I read that nu was skipped, and that's spelled NU because people might confuse it with the word NEW. Xi, XI, if I'm pronouncing that correctly, is skipped because that's a popular name in China, including their premier, I guess. So anyhow, what happened with this Omicron variant, it was discovered on November 24th in South Africa, designated as a variant of concern by World Health Organization on November 26th. So 2 days later, that's very fast. They were very concerned with this right away, and that's what seemed to push the markets lower. So now everybody is wondering, okay, how bad is this? How is this going to affect the market? Are we going to have to go through shutdowns again? I mean, they talked about the Delta variant, where it affected a lot of people, a very high transmission rate. My opinion, or really our opinion, is that there was a big knee-jerk reaction here where everybody was concerned that this could be bad, and they didn't stop and really look at what was going on. So I think the worst news was probably factored into the market, and that's what drove it lower. But again, I'm not an infectious disease expert by any means, so this is what I'm picking up, and I think that the market's seeing it the same way today, and that's why we're so much higher. Is everybody just panicked? They were worried that there's going to be shutdowns and restrictions, and this was going to be real bad. And now what they're finding out, and we're still early into it. These viruses take a couple of weeks to develop and find out how bad they are, how transmissible they are. And at this point, we're about a week and a half into it, so we don't know the full picture. But it seems that it's very mild, that the symptoms are mild. It's highly contagious amongst people, but the symptoms are really not anything worse than, say, the common cold or a flu. Might keep you home from work for a day and you're probably not feeling great. But it isn't hurting people in the way that some of the other variants were. And I think once we get past that, the market will recover. A couple of the headlines that I've seen is, I found it interesting, Switzerland backtracks on quarantines for foreign visitors. As you read into that further too, they put out these restrictions right after our Thanksgiving. They obviously don't celebrate that over there. Then a week later, pulled it back, but it was mostly because so many people had canceled holiday plans to travel to Switzerland. And they said, "Oh, this isn't that bad. We want to encourage people to come visit our country and spend money." So they peeled back their quarantines and some of their travel restrictions. Um, Another thing, and as of 4 or 5 hours ago, and this maybe has changed too, there has not been a single death reported from Omicron. Uh, as this gets, generally speaking, with these viruses, as we've seen, it takes a couple weeks, like I was talking about. So I'm sure that there probably will be at some point, but so far it doesn't seem that bad. And then even this morning, South Africa came out and said that they were expecting this, huge uptick in hospitalizations because of this variant, and it just hasn't happened. So I guess bottom line, what I'm trying to get at here is, it doesn't seem that this variant is as bad as it needs to be, and it sent the market lower, but it appears that the market's going to shrug that off and move on. Did want to spend a minute talking about the Federal Reserve. I mentioned this a few minutes ago with Chairman Powell's testimony before Congress. And this really did drive the markets last week, and it probably will here over the next couple of weeks. Historically speaking, the Federal Reserve is very good about telegraphing their intentions, so a lot of the movement is factored into the market rather quickly, really real time, ahead of time. So we don't see a lot of shocking moves or short term, again, I'll call it knee jerk reactions. But last week, Chairman Powell's testimony was a little unexpected, given all that's going on. Not totally, though. If you look at inflation's moving a lot higher, so the Fed needs to do something to keep ahead of it. And in our view, he's absolutely doing the right thing by at least discussing it. So what they're going to be doing next week at their meeting is discuss that taper, like I was talking about, and how to maybe accelerate it. Previously, they said, okay, we're going to start it now and probably wind it up by about June of next year. Now they're saying, okay, maybe we do it a little bit sooner in March or April. And what that will end up doing then too is it really sets the stage. Once they're done with that, they can look at bringing up, hiring their short-term interest rates, the Fed funds rate. So if there's something called the dot plot, and this might be hard to see. I mention it because it'll probably hit the news next week. So what the Federal Reserve does, the Board of Governors, is they take an anonymous survey of where their members think interest rates are going to be. And like I said, it's a little hard to see. So this is from September. They do this on a quarterly basis, and there'll be another one that comes out next week after their meeting. As of September, there was a few people thought in 2022 there'd be one interest rate hike. Now it looks like two are more likely. There's some people even saying three possibly. So we'll be paying attention next week to see what the Fed's thoughts are on this. And then 2023, we see, really, if you look at the averages here, it's looking at one next week, or next year, I'm sorry, for the year after, then another four in 2024, bring us up eventually to a Fed funds rate of 2.5%. From zero right now. Over the longer term, this seems maybe a little optimistic. I think with inflation moving as high as it is right now, and the Fed finally acknowledging this, we'll probably see interest rates move up a little bit more, possibly faster. And I think the big question now is, how long does this occur? It's looking to be 2 or 3 years out, so nothing that we need to concern ourselves with really in the short term, but certainly something to pay attention to. Another thing that was interesting last week is we pay attention to the spreads, the interest rate spreads between the 2-year and the 10-year Treasury. So the 2-year is a proxy for short-term rates, probably a little more dependent upon things such as inflation in your shorter term. The 10-year Treasury is looking out further, and a proxy for, I guess, longer-term inflation and where they think it's going to be. A little hard to see here, but there was a big the spreads really came in quite a bit, and this shows that the yield curve is flattening. I think that and the reason why is the 10-year Treasury yield last week dropped quite a bit, 10 to 15 basis point, while the 2-year Treasury went up in yield, probably 10 basis points or so. And so the spread between the two is really narrowed quite a bit, and I think that over the next year we might see this even more. And if the narrower this gets, it indicates the higher chances of an economic slowdown. So I mentioned this now. This is kind of looking at we're talking about what's going on between now and the end of the year. And this is something kind of a foreshadowing of what we expect to see next year. One of the things we're really going to keep close eyes on. So looking ahead, some of the things that we're really keeping our eyes on going forward here. We've seen this volatility over the last couple of weeks. Obviously, what happens with the variant as more information comes out, the COVID variant Omicron. Uh, how bad is it? What's the transmission look like? Hospitalizations, deaths. And I guess bottom line, as far as the economy and stock market are concerned, we're really looking at shutdowns again. There's certainly shutdown fatigue here. Over in Europe, there's been a lot of restrictions placed in a lot of countries. They have higher infection rates. You can argue the merits of those, whether they really work or not, or they're necessary. There's a lot of people that feel that they're not necessary and an infringement on rights, which I fully understand. People here in the U.S. feel the same way too. But if there were a shutdown, even in the foreign countries, it would possibly impact what's going on here. We already have, supply chain constraints, partially due to factory shutdowns overseas. We saw that with a lot of the retail sales numbers, where they said that some of the things, I think it was Nordstrom's came out and said that a lot of the women's items that they wanted to sell or there was a high demand for, they couldn't supply because factories in Southeast Asia where they produce these were shut down. So anyhow, eyes will be on the Omicron variant. What comes out of that? Like I said, we expect it to be rather mild and probably not moving the market a whole lot more in coming weeks, except probably as people realize it's not as bad as they thought. We'll see a market bounce, but we're also looking at inflation later this week. The CPI number comes out on Friday. PPI comes out, I don't remember if it's Monday or Tuesday of next week. What's a little concerning with that is, the inflation CPI is expected to come in at 6.7%. Last month it was 6.2, so it's rising, but it also seems to be accelerating. And as long as it's accelerating, it'll keep moving higher and higher. We're watching to see if there's like a deceleration in the upward movement. Looking out longer term, we expect inflation to stay here. I don't know that it'll be runaway or rampant inflation. It could be, hopefully not, but it's still elevated. 5 or 6%, even 4% ahead of where the Fed would like it to be their comfort zone. So we'll be keeping close eyes on that over the next week here. Obviously, this time of year, with consumer spending and retail sales, the consumer makes up 70% of GDP. That's a big one. Indications are people are out spending money. I know, personally, I somehow got roped into doing some holiday shopping over the weekend. The stores were packed here. I know that's anecdotal and certainly not evidence of widespread spending, but shelves seem to be well stocked. People are spending money. I think that there's some pent up demand due to the pandemic. So we'll see a lot of spending occur this holiday season. I do wonder though if it's kind of sucking some forward, or after we get to the first of the year, if we don't see consumer spending slow down a little bit. And that's obviously historic or seasonal as well. We'd expect that, but even more than usual this year. I think people are out in full force spending money now, and it might slow down significantly going into the early part of next year. So we'll see. As I'd mentioned, there is the Fed meeting next week, which has the potential to move markets depending on what their discussion is regarding the taper. This easy money has been out there for so long; it's really been fueling the stock market. This huge growth, this huge bull market that we've seen over the last 10 plus years or so. And so if they decide to taper a little faster than normal, which further indicates that interest rates will move higher next year, that could put a bit of a damper on the stock market. I don't know that it will on the entire market, and we'll probably see a rotation amongst sectors. Tech's maybe had its run now, and we'll see other sectors do a little bit better, more of the value plays, for example. Things that are sensitive to interest rates as well, such as financials. So eyes will be on the Fed. And then lastly, what we call a Santa Claus rally. And a Santa Claus rally generally is a rally that we see at the end of the year between Christmas, New Year's, going into the early part of the new year. There's a number of theories as to why it happens, one of which again gets into, it's kind of a slowdown, fewer people trading. There's most people position their portfolios how they expect for the end of the year. I think this year we're going to see a Santa Claus rally just based on what the market's done the last couple of weeks, where they've probably overreacted to the news. When everybody steps back and looks at things fundamentally, everything's intact with the economy. The numbers look good. If you look at all the economic releases, consumer sentiment strong, retail spending is strong, consumers are strong, jobs numbers look great. GDP growth so far is solid. That'll be an interesting one in the next year to watch. But I think closing out this year is wouldn't be surprised to see a bit of a what we call a Santa Claus rally going into year end. So with that being said, I'm really getting to the end of what I had to share. I guess I'll wrap it up and mention that we do have our market huddle scheduled for the next couple of weeks. I don't have topics on here. My apologies. We've had to looking at the market, make a few adjustments. I think one of these we'll probably talk about RMDs, and another one we'll talk about just some really last minute year-end tax planning tips. We've talked about some of those over the past couple of weeks, but there's a few more that have come up that we trying to squeeze in. Along those same lines too, we are running out of time. So if any of you do have things that you need to do, whether it's tax related or portfolio related, please don't hesitate to give us a call so we can get that in by the end of the year. Things start to really, working with TD, for example, they have their cutoffs. So, if we get a request at the very end of the year, there's a likelihood it can't be done, not anything within our control. And also we are still collecting toys for tots. We have the drop boxes here at the office. Feel free to drop those by at any time, unwrapped gifts for needy children. So with that, like I said, give us a call if there's anything we can do to help. Open it up to questions. I see Mr. Nordstrom's asking about the housing going forward, and that's a great question, Kurt. Been reading, there's a lot of people very bullish on housing, saying that there's a lot of pent-up demand, especially with millennials. And the other thing that the pandemic did is it changed how people are able to work. So there's been a bit of a migration out of some of the larger cities into smaller cities. People have a little more mobility. A little more latitude in where they can do their work. So some housing markets are remaining strong. I think as long as interest rates remain low, even if we do see interest rates move up next year like we expect, they're still at relatively low levels. I think housing is going to remain strong for the time being. We've seen some pretty substantial price gains over the past year and a half, and those will probably slow down. I don't think that we're going to see a drop like we did, say, in 2008. But I think prices will probably stabilize. But at this point, it seems like demand will stay real strong, and housing looks to be good for the next number of years. We'll call it 4 or 5 years anyhow, and some of that might be dependent upon what happens with interest rates over the next year or so. Do you like Series I bonds? So that's inflation protection. Yeah, certainly. That makes a lot more sense than buying. You look at a treasury, a 10-year treasury paying now at 1.35%. It just doesn't make any sense to lock up your money. We've talked about this a little bit. The real rate of return, which is the return you're receiving less inflation. So real rate of return on a 10-year treasury, 5-year treasury, anything is negative. With the I bonds, you're protecting against that inflation because those prices do adjust based on inflation. You're always behind a little bit, but it still makes that adjustment, and that's certainly a good way to protect against some of the inflation that's going on right now, and a nice alternative to a fixed rate bond. All right. Any other questions, comments, thoughts? Just hoping maybe somebody challenge me, call something out that disagree with, but not seeing anything. Like I said, thank you all for joining. Yeah, please join us again next week. We'll get that out as to what we're going to do. I appreciate everybody hopping on. Again, sorry about the little email snafu, but it looks like we had a number of people on. Number of people will catch the replay, I'm sure. And as always, we're here, so don't hesitate to let us know if you have questions, or I'm glad to talk about the market or anything investment related, of course. But otherwise, if you're here in the northern latitudes, Minnesota, Wisconsin, stay warm. Chilly day out there. If you're down south, and enjoy the warm weather, we're envious. So take care, and we'll talk again soon. Thank you.